fears over the future of the Eurozone eased slightly on Thursday after the markets at least gave a resounding thumbs up to a Spanish bond auction. Spanish stocks surged more than 2.5%, not necessarily a surge, I guess. They were up 2.5% on the news. But as Al Goodman explains, passing this first test of the year doesn't mean that the debt crisis there is over.
Joy on the Madrid stock market and what some analysts are calling some very necessary breathing room for the beleaguered Spanish economy after the first bond auction of the year. The Spanish government raised 3 billion euros, or about $4 billion, in the sale of 5-year bonds, and it was oversubscribed, about twice as much demand as for what was offered. The downside, in order to attract investors to the troubled Spanish economy, the government had to pay a higher yield. 4.6% marginal rate this Thursday compared with a 3.6% rate just 2 months ago, the last time there was a 5-year bond auction. Moody's, the ratings agency, estimates the Spanish government will need to raise 170 billion euros, or about $220 billion from the markets this year. They're off to a good start, but there's a long way to go. Al Goodman, CNN, Madrid.
Yes, there is. Italy, hot on the heels of the Spanish with its own auction on Thursday. It sold $8 billion worth of 5- and 15-year bonds. Demand healthy, but the price was slightly higher than at the last auction in November. Portugal also came in on target a day earlier, selling $1.5 billion worth of 3- and 10-year bonds. Both auctions were oversubscribed. Yields on the 3-year bonds rose slightly, but actually fell on the 10-year bonds. And that's important, taking some of the heat out of the speculation that Portugal may need a bailout. Well, bond sales are a short-term fix, of course, but longer-term plans are afoot. The European Commission, though, is in talks to double the European bailout fund to $1.5 trillion to help member nations in crisis. Well, let's get a closer look at where we stand. Kevin Dunning from the Economist Intelligence Unit joins us now. I think the first point here needs to be simply this: who's buying this debt? Do we know?
We don't know exactly, but we do have a bit of an idea that it's not all coming from within those countries, especially in Portugal. A lot of it's coming from outside. There's lots of speculation before the actual auction that China was interested, Japan was interested. There's not a neat breakdown, but certainly it's not all coming from, say, Portuguese residents, Spanish residents.
Which is important. All right. What's the message from what has been, let's call it a decent uptake on these bond auctions?
I mean, I think it's a bit of a qualified success in the sense that, yeah, there was very high demand for the bonds, but at the same time, they still had to pay quite a lot for it. So, I mean, I think it's a start, but also the problem is you get one away and you have to start and think about the next lot of money you have to raise.
Yeah, and effectively offering people more and more and more to effectively make these things work. In an article in the New York Times this week, the influential economist Paul Krugman argues that the pace of recovery in Europe is being slowed by a single currency. He says that Europe lacks the institutions to make a single currency workable. Now, we've heard that argument before, but coming from a man as informed as Krugman is, does that worry you, or should it worry those who use a single currency? Of course, we don't here in the UK.
Well, I think, regardless of what Mr. Krugman says, we should be a bit worried about how fast the economy is going to grow over the next years, because given how tough the cuts are that they're implementing, which have to be very fast and very steep to actually make a difference, the economy is inevitably going to slow, and places like Portugal have had a poor growth rate for a long time. So at the same time as you're taking a lot of money out of the economy, households and companies are struggling as well under their high debt load. So really we're asking a lot of these countries to do it all on their own, and that's why I think it's good to have the bailout fund standing behind them.
Will it be used? That's the question. I mean, you know, people will be asking tonight, they see the bond auctions, they say, oh, Europe may be out of the woods. Is it? Do we need these bailout funds?
We absolutely need them, there's no doubt about that. And we're not out of the woods at all off one bond auction. You know, these countries have to raise a lot of money this year. And for my money, I think Portugal is going to have to access the bailout fund, if not now or the next time. I mean, sometime in the coming year, they're going to have to go for it. And, you know, it's not the end of the world to do that now, seeing as the money that's on offer there is a lot more stable. You know, it'll allow them to go for fiscal cuts without worrying about where the next chunk of funding is going to come. The worry after Portugal is, does Spain need the same thing? And I think that's still unsure, but they need a whole lot more money, and that's partly why the European leaders are thinking about raising the amount of money that's available.
It's a lot of money. All right, we're going to leave it there. We thank you very much indeed for joining us.